We could start with the provocative question of the panel that's projected above us. Are we at a turning point for investor preferences, or will US big tech continue to dominate portfolios? Helen, perhaps you'd like to start the ball rolling.
Yeah, what a question to start with. I mean, the short answer to the question is we're not at a turning point. It is still the key theme that people are very focused on. But I think what people need to really understand is that the earnings remain robust in the big tech space. So there's a lot of discussion about whether this is a bubble, but the earnings and the capex and the spend power of a lot of those Mag 7 names is very, very strong. They trade around 40 times, 17% earnings next year. I mean, that is higher, a lot higher than what we're seeing for the rest of the US, the 493, as it were, and in particular, a lot higher than what we see in Europe. So if you look at that trade-off, then it does feel a little bit at the top end of valuation. But what generates returns? So returns are earnings and the earnings power of these companies. But it's also driven by the cost of equity. And what we've seen is the cost of equity for these names just continue to go down. And the cost of equity is basically just what people are willing to pay or what people want back from taking that additional risk. So it links into liquidity risk, and it links also into how confident people feel and investors feel that the earnings will come through. And what really the market is saying is, we are confident in these earnings. We're confident in the earnings that are being forecast. And the liquidity premium is basically zero. It's much, much more liquid market. So we're okay about that cost of equity continuing to shrink. Do I think it's going to be the 40% we've seen this year? No, I don't. Let's kind of be sensible in what the returns will be, but there's still going to be high returns. Do I also think that US big tech dominating means that you can't invest elsewhere? Absolutely not. There are great European companies at really, really compelling valuations. However, in terms of the question of are we seeing investors pivot away from the big tech? Not really. We're seeing some broadening out in the US, but it still remains the main focus of portfolios and the main area of focus. So some broadening out. Europe remains interesting from a valuation perspective for some companies. But the big pivot away from this big tech exceptionalism, I don't think we're going to see it in 2025.
Interesting. The word bubble has been used a couple of times this morning, but maybe we'll come on to that later. Lucas, what's your take on it?
Yeah, so our view is we are at the early stages of a broadening out. Just looking within the U.S., if you look at the S&P 500 cap-weighted versus equal-weighted, the equal-weighted S&P 500 has outperformed the cap-weighted only 2 of the past 7 quarters, but one of those 2 was in the third quarter. And there's some risks to the cap-weighted market. There's a very high correlation between starting valuation on the S&P 500 and the ensuing returns over the next 10 years. And if you look at where the S&P 500 is trading today, at these valuation levels, historically, you would expect low single-digit returns going forwards over the next 10 years. Now, that's not necessarily our base case forecast, but it does highlight that there's some medium and long-term risks. We do see small caps likely to outperform large caps. Small caps are trading at a discount to large caps everywhere in the world. That's the US included, and that hasn't been the case for most of the last 20 years, so the valuation starting point is compelling. And then this stage in the cycle is usually where we start to see small caps outperform large caps. Now, it's hard to imagine with the S&P 500 up 28% as of this morning and the US the best performing market in the world, but this does mean the rest of the world could outperform the US. The US has led the rest of the world for the past 15 or 16 years. That's the single longest period of leadership by one region in the past 60 years. The valuation gap between the US and the rest of the world, there's always been a valuation gap, but it's been the widest. It's the widest today that it's been since we have data. So that's going back at least 30 years. There are also reasons to be constructive on other regions. So Janus Henderson, we're constructive on Japan. We think the corporate governance reform is going to drive sustainable improvements in returns on equity and enhance cash return to shareholders, and both of those will be good for stock prices. We can even see reasons to be constructive on European equities. And I know that would make us a bit of a contrarian probably in most crowds. Of course, there's a valuation discount, which is the widest ever. That holds up, by the way, even when you look sector by sector. So an industrials company in Europe is cheaper than an industrials company in the US. And importantly, buying European equities doesn't mean you have to be constructive on Eurozone GDP. Remember, the average European company sources 60% of revenues outside of Europe. Now, some of that's in the US, where people are worried about tariffs, but we've analyzed the US exposure of European companies. 80% of that exposure is either services or it's local for local manufacturing. In other words, it's built in the US and it's sold in the US. So both of those, both services and local for local, would be protected from tariffs. All this to say, there's a rapidly changing backdrop. We think that means this is the time to get exposure to active management. In past periods of market broadening, you can see active investment strategies have outperformed or have been more likely to deliver outperformance. So when you don't have 7 stocks driving all the returns, you need great fundamental research and disciplined portfolio management to figure it out.
Right. Well, it's reassuring to hear some positivity around European equity, so thank you for that, Lucas. Perhaps we'll have some more of that from Matt.
Well, when you're the third person or the 3-person panel, and one said no, and one said yes to the question, it only leaves you with the middle ground. Look, turning points are really hard to predict. And I would certainly shy away from pointing to a turning point, and the turning points are very easy to spot in hindsight, but very hard to see through the front of the windscreen. That all said, money flow continues to be very much towards US equity markets above other markets. So look, that may be a lagging indicator. Retail money tends not to be a leading indicator, but money flow continues to favour US equities over non-US equities. So there's no evidence there of a turning point. Again, if you look back in the rearview mirror, your GDP growth obviously has been larger, faster, higher in the US than it has been outside of the US or other developed markets. If you look to 2025, most people would expect that to continue. There's been some excellent articles written by Robert Armstrong this week in his Unhedged column talking about productivity in the US versus Europe and that differential and how that can compound and is compounding and is potentially driving this valuation discount that the panel is opining upon. That all said, factually, we look at things like the NYSE advanced decline ratio, so very simply, number of stocks that are going up, advancing versus those that are going down, that's at record highs. So the market is factually broadening out, despite what we all think. Which really leaves me just to emphasise the point that Lucas raised there right at the end, and that Helen also touched on as well, is that this doesn't preclude us from being either or. I don't think we have to be focusing on one or the other here. There is increasingly an opportunity for those that are a bit more active and a bit more nimble and less passive in their focus to add value by choosing where to allocate capital. And that hasn't been the case the last handful of years. So it could be that we're entering into a really fertile environment for active management to allow managers both to exploit those opportunities that might still be there, but also to position themselves when that turning point does, frankly, inevitably come.
Flying the flag for active. Thanks very much, Matt. So we're going to look at some research that we've conducted as we've talked about the Investor Pulse research. A few graphs. Apologies if this reminds people of the sort of COVID government communications, but I'll try and keep it light. So this one, we want to look at, how do you think the introduction of dividends from US big tech will change how investors think about the best places to find dividends and their dividend policy, and we've seen that the majority think that there's going to be that a significant number of dividend-paying stocks will change their dividend policy to increase payouts in order to remain favoured dividend plays, and the majority, albeit a large minority in the UK, unsurprisingly, think there'll be a migration of dividend investors away from the UK and into the US. Lucas, your take on these findings?
Yeah. So I guess maybe the middle one might be the area where we might disagree a little bit. Certainly these U.S. big tech companies either instituting or raising dividends can be compelling strategy for certain investors, particularly ones who are looking for dividend growth. But if you look at the payout ratios and the yields, they mostly don't meet the threshold for income-focused investors. I mean, the dividend yield on the S&P 500 is a little over 1%. Europe and UK, it's more like 3 or 4. Some of that reflects cash returns, right? Historically, share repurchase has been more in favor in the US and less so out of the US. But if you look at total cash return to shareholders, so share repurchase plus dividends, it's higher in Europe and the UK at 5 to 7% versus the US at only 3%. So we do think income becomes an increasingly important component of return. That's true both because of the aging of the population, and you need dividend income to help make up the gap that may not be fulfilled by pension schemes. But because if market returns are lower, income mathematically becomes a more important component of return. But ultimately, for investors who need a relatively high level of current yield, most of the U.S. market is still too low for that.
Helen?
Yeah, I mean, we obviously saw and did the same research. The S&P is just above 1. At the Mag 7, 2 of them don't have dividends. The others, they're very, very low yields. So I was surprised by this. I don't think people move into these stocks for the yield, and they do it for very different reasons. The only portfolios it will shift is a portfolio where every stock has to have a yield. It does then allow you to allocate to this, but then, of course, what it then means is that you have to then increase allocations to much higher yielding stocks to make up for it. So it does allow some switch, but I was surprised at quite the level of the numbers that came through here, because A, the yields of these names when they do get announced are just too low, and B, I just don't think it's the key driver at all for why they're included in portfolios. So I don't think it changes things. Ultimately, if you're in the UK, you have to have a premium to be an income fund. You have to have a premium to the income of the benchmark, and these are not going to help you. So I was surprised actually that the results came out, but when they do, we have to listen, right? So unfortunately, all this does is give another reason why people are investing, and actually this is something I've been thinking about a bit recently, is it feels people are looking for a reason. Here's a reason why I want to invest in the US. Here is a reason why these names are great, and dividends just ticks another one of those boxes without necessarily from a mathematical perspective it making sense.
Matt, I promise I won't come to you last every time. But do you have an alternative take on these findings?
Not really. I mean, I very much sit on the right-hand side of this chart. I don't think that changes anything at all. These are still the growthiest of growth companies. I do think here in the UK we get a bit too obsessed by dividends. Generally, this is obviously a very dividend-hungry market. There's plenty of markets around the world that care a lot about income, but we are particularly obsessed about dividends in the UK, and look, we could probably go into a whole long conversation about whether that's part of the malaise in the UK market, whether we're too focused on paying out dividend, you're returning capital versus reinvesting it. I mean, ultimately, these companies are paying a dividend, I would argue, because they are generating so much cash that they can fulfill all of their reinvestment needs and then have cash left over, albeit not quite the yields that we all think perhaps that would attract new investors. Maybe another sort of slightly cynical thought to go with this as well, which is just to recognise that so many stock options have been key to driving retention and indeed encouraging certain talent to join certain of these tech companies. And there's a lot of employees inside these businesses that are shareholders, and actually this is a way of them extracting a little bit of capital from the business above and beyond their salary and rations. So maybe the cynical part of me wonders whether those founders or those who've been lured in by stock options are also being additionally paid via these dividends, and whether that's actually another reason why we've seen tech companies introduce, albeit quite skinny, but introduce yield.
So sort of a talent sort of war.
It definitely doesn't harm, does it? It definitely doesn't harm if you are both being rewarded in stock options, and obviously that's been a lucrative thing to be rewarded in, but also potentially receiving a little bit of a dividend to be paid while you wait.
Really interesting. We conducted some more research, and we asked how highly investors rate the robustness and reliability of the information, data and research they receive from a variety of sources, and there's not a huge differentiation. We noticed that UK and European investors seem to have a higher opinion on the quality of sell-side research than relative to US investors. So it'd be interesting to know why that might be the case. And Matt, you'll be pleased I'm coming straight back to you first for your take on this.
I think it's horses for courses, largely. I think we all recognise there are a plethora of different approaches towards investing. Some are very fundamental and will put great stead in company strategy and how management are planning on reinvesting shareholder capital and growing their businesses, and some will be much more quantitative driven and actually see engaging and understanding management strategy as something that's completely unnecessary when it comes to a particular investment approach, and both have different merits in different ways. So when I think about investment teams that work for us at Jupiter and their different approaches, all these things here on this chart are in some way relevant. Data is obviously crucial. It's very hard to, I think, manipulate data. So when it comes to being highly reliable and robust, the regulatory restrictions, the legal parameters in which we operate make it really hard for this data not to be reliable and robust. Perhaps the more interesting question is whether it's everything that they need, whether there are other things that could be useful above and beyond this data. Now, of course, there are some things here as well that are not just about raw data, but about interpretation of data. And that's perhaps another very interesting angle here as well. I do think increasingly with data so prevalent, tools so readily available to us all, actually we're all much more interested in ingesting raw data rather than relying on the outputs of those that are analysing and collating that data for us. So I don't think it's surprising when you look at left to right, on the left-hand side, raw data is in some ways slightly more trusted than perhaps some of the output by those that are collecting and aggregating and then analysing data.
Yeah, and I also remember looking at the cuts of this and seeing that in the US, data scraped by big data, AI, NLP algorithms is much more popular or is deemed to be more highly rated in the US than in the UK and Europe. Lucas, any thoughts on this, on the reliability of information?
Well, so interestingly, when we did get a heads up that this question was coming, and so when I did a survey of our investment teams just to see if they would align or disagree. And I mean, I guess the first thing to observe is it is a pretty tight distribution, right? 34 to 41, it's all pretty close. That said, I think one place where we maybe disagreed a little bit was this information provided by companies. We were a bit more constructive on that. We trusted it a little bit more. And I think the background may be like, as a great investor, you're trained to be skeptical of management, right? Like that's one of the things that, we often train investment professionals to do. But that's more about, the management's interpretation of data or their extrapolation into the future. It's not really, is the data itself that they're presenting factually correct? We sort of assume, given the regulatory environment, that whatever a company puts out should largely be accurate, and particularly given like the audit environment. So yeah, that's maybe the one area that we disagree a bit. Helen?
Yeah, very, very similar. I mean, I was shocked. I was a sell-side analyst in a previous life, so I was kind of that 41%, and you can't sneeze on the sell side without it going through a supervisory analyst. So I was quite kind of surprised by how low that was, and I did wonder whether the question was almost being read as how useful is it, and it would also then explain that US difference because. In the problem that you have is, information is less useful if it is more readily available and everybody has it. Then if everyone can see it, how useful it is to have an edge on it. It probably also explains then why things like data scraping, where you have so much that you can scrape in the US, can be incredibly useful. But more and more for us, the data that is important is the things that we can get from non-traditional sources and get it very, very quickly. So credit card data is the best example of that. Really understanding during COVID, where everybody thought the world was stopping spending, but very quickly credit card data saying, actually it is still spending, it's just spending on different things. That is incredibly important. Another thing we're looking at, actually going back to that first question, when we think about AI, there's a lot of conversations. I mean, I even, things are in the mainstream when your friends and even my mum starts to say, this AI thing, how would you actually use it?
Must be something.
Exactly. What is everything in companies? It's selling things to end consumers. What is AI selling to end consumers? So we're looking at things like ChatGPT, Perplexity. How much do people continue to play around with what AI do? And that continues to grow, which again is an indication that, even if you're cynical about how much AI might change the world, at the moment, people are still consuming the goods that the US companies are producing. Or the US dominant companies are producing. So yeah, I was very surprised by quite how low it was. And I did wonder, exactly as you said, Matthew, whether the interpretation was more, how useful is this in giving you an investment edge when you're thinking about your portfolio positioning. In which case, I would also agree. The companies and the conversations we have with companies are incredibly important.
Let's not forget, one size doesn't fit all here as well.
Yeah.
So it's very easy to look at this through a developed market lens. in the US or the UK, where markets are highly regulated, information is provided freely. That's clearly not the case still in lots of geographies. Lots of emerging market geographies, that information and the robustness of that is just not there. But the journey is still there, right? So 30 years ago, the advantage as an investment manager was by having information that others didn't have. Fair disclosure didn't exist until the late 1990s in the US. Today, the advantage is how you utilize the breadth of information and what you ignore. So today it's about picking, whereas before it was about accessing.
Yeah.
Interesting. And I should say traditional media is a very broad question. I'm sure if we'd asked some of the great institutions represented here today, it'd be much higher. So final slide, I promise. So we also asked investors where they feel are the biggest gaps in valuable information provided by companies' management teams. Talent attraction and retention information pertaining to that appears to be a fairly significant issue, particularly for US and European investors. Helen, I don't know if you had an initial take on that.
Yeah, so I mean, actually, I did a bit of a straw poll on what our guys were saying, and for us it was that second one, mainly because on the first, it is very difficult to get a tangible answer that really is going to help you with an investment decision. So, what do you say? People say, look, we want to attract talent. This is what we're doing about it. But actually, how you then think about that in models, in earnings flows, and therefore in the impact on share prices is quite difficult to translate. When we think about things like inflation, and I do have nervousness about whether inflation is actually a little bit stickier than maybe we thought, that is something where really understanding that for a business can help us as investors think about, the earnings going forward, and therefore whether or not a particular company is more or less exposed to that. So for us, I think it's about not just the questions, but also how you translate that question into an investment decision and an investment outcome, of which things like inflation were and distributions to shareholders were probably more important than talent.
Yeah. So the communication around the impact of enduring inflation is perhaps slightly lacking, but you'd like to hear a bit more of it.
Exactly, because that's something that we can take, and then, as I say, if we understand it, gives us the investment edge. Yeah.
Matt, you're obviously an investor, but also the CEO of a listed company. So your take on your play both sides.
I am. So I'm poacher turned gatekeeper. You say 20 plus years as an investment manager, now CEO of a company that obviously does investment management. So I can see this both ways. I mean, I do think there's a lot of information out there for your average company that most investors, frankly, are too lazy to ingest. I look at the amount of material that we produce, say, as a listed company. We're a relatively small cap company, but we still have the same level of disclosure obligations to other people. The multiple, 200 plus pages of our annual report, the amount of information we provide to the sell side, that only increases. And certainly on the journey that I've gone through as CEO of Jupiter, we've increased our disclosure, but analysts and investors still want more. Yet you still find yourselves engaging with analysts and the sell side as well as underlying investors, and there's a real gap in the ability or the time taken to ingest that information that is out there. So look, I think it's very easy to ask for more. I think a lot of things might actually rest first or be better utilised before that request for more is there. I mean, the other thing as well that I think is very different today, clearly with data available, tools to analyse data and collect data much more readily available, quantitative data is easier to process than qualitative data. I think that comes out here as well. When you think of where people want more, it's actually trying to work out how to systematically process that softer stuff. How do you understand the culture of a business? How do you know that the company is doing the right thing socially when it comes to ESG-based requirements, appropriate attention on governance-related issues? These are things that are much harder to judge from the outside looking in. But then, of course, that then comes down to the skill of the active manager and their ability to find ways of using, to Helen's point, alternative data that might provide those insights that aren't readily otherwise available.
And dare I even say, even the feel for culture and talent is something that you need to kind of feel rather than generative AI probably can't assess culture.
And there's plenty of tools out there now that will take conference call transcripts and try and judge the optimism of the management team by the words they used, the extent to which they're trying to spin you, or the extent to which they are genuinely heartfelt. Did the manager look me in the eye when he answered the question, or did he stare at his shoes because he's shifty? Was he sweating? Was he rubbing his hands? Look, I'm sure there is something in some of these things, but I think it probably goes to the extent to which we're all looking for an edge, frankly, in what's a really competitive marketplace.
Lucas, final thoughts on this?
Just a couple of quick ones. One is, so we did the internal poll. We agree on the ability to attract and retain talent as being kind of the largest gap where we'd really like more information. And I think, the point there is we do try and invest over the long term, and we think culture is a really important determinant of investment outcomes and financial outcomes, right? And it's tricky because for those of us who spent many years investing, like you can't see it on the balance sheet, right? But we do think ultimately, it becomes a really important driver, and so we're very hungry for more information in that respect. And I guess the other one that surprised me a little bit was our team felt like we wanted a lot more information on how the company can use AI to become more efficient. And if you look at data on back to Matt's point about how many times AI is mentioned on conference calls, like it's grown exponentially over the past couple of years. But I think what our team has felt is, there's sort of superficial discussion of it in some ways, but we're really looking for, kind of concrete examples of how companies can leverage AI to drive greater efficiency or greater revenue growth. So those are maybe the two that I'd call out.
Yeah, great. So something for management teams to ponder. Great. So we've got about 10 minutes for questions. I want to leave plenty of time for that. So thank you very much for your thoughts for the panel discussion. Question, Stephen?
Hi, Steve Clapham from Behind the Balance Sheet. I was wondering how you're using AI to make your business more efficient. And can you talk a little bit about, obviously I don't want you to give away any secrets, but you talk a little bit about the resources you're putting behind it and how that's changed 23, 24, and 25.
So from communication around use of AI to discussing how you're using AI, who would like to start the ball rolling on AI?
We
should probably leave this to AI to answer, really.
So a lot of it has already been talked to. So we're using a lot in terms of kind of ingesting information very quickly, so that a portfolio manager comes in and very quickly from the start can see, okay, for the positions that you own, here's all the news flow. And then what we're also developing is the tools that really look, it's so interesting listening, the differences between what transcripts say and what's actually in the model. That is the key for me is, if you've got earnings where you are forecasting a particular margin compression, let's say, is that different from the narrative that actually the company is getting to? And that's something that we are doing to kind of be able to map against that. Again, just going back to some nervousness maybe around AI, there is an element to which everything needs a primary source. So if everyone's scraping the sell side, somebody's still got to write that sell side note originally. And a lot of internal conversations we're having are on things like the models. I'm old school. I learned my craft by building models. I learned how to analyze a company through doing that. So there's always a bit of me that's like, okay, you learn a lot by going through primary sources, but that's a conversation that will take us all, a whole other panel, I think, probably. So we're doing a lot of that. In terms of resourcing, we're fortunate, obviously, in terms of our scale, that we're able to do it very centrally. We have capabilities over in the US as well that really help us deliver that. And what we're trying to develop is very much hub and spoke models, that the core engine rooms are the hub, but we still have people who sit within the investment teams who listen to the investment conversation, say, I know how to help answer that, utilising alternative data and AI. So the hub and spoke model are the way that we're kind of building it. I think if it's too centralised, you don't get that nuance of the investment teams. If it's too separate, you don't obviously get the scale that you can benefit from.
Very interesting.
I've probably got a slightly more controversial view. Maybe that's panel 101 as well.
Go for it.
I think in 1999, had we asked the question, who's using email as a competitive advantage? We probably would have laughed at that. And certainly now, if we were to answer that question in hindsight, we'd say, well, everyone's using email as much as a competitive advantage. I think we're getting there with AI. I do recognise that we're all still learning, but I do think AI is just being embedded everywhere. That's accessible to everyone. I think there's differences in how skilled we are as individuals or maybe as organisations in utilising it. I'm yet to be convinced, frankly, that any of our peers on the asset management side have a big lead or doing something different, either from a revenue perspective or from a cost perspective, because of how they are using AI. I observe that some people are talking a lot about it. Because I think back to Lucas's point about conference call scripts, the AI premium by being seen at the leading edge, I think is absolutely there. Yeah. But look, I'm yet to see. Yeah, right. And I'm yet to see any evidence from the peer groups that I circulate in, or the consultants or professional services firms we engage in, that suggests to me there's a competitive advantage that's being harnessed by one of our asset management peers, either in terms of how they run their business or in terms of how the investors are utilising it to choose individual assets.
Any thoughts, Lucas, or we can go to a question?
I'll just mention a couple things. One is, certainly as a firm, we're investing behind AI. We've created a central disruptive financial technology team that's led by our head of innovation. So, and there is, the spending was up 24 over 23. It will be up 25 over 24, as you'd kind of expect. There's just a couple things I wanted to point out. We see a couple key areas of benefit. Obviously, one is in the investment process. Another is in our client groups. But there's an important nuance there in both of them, which is in the investment process. We don't see AI is replacing humans, right? So we're not kind of testing ways to have portfolios purely managed by AI. When I think about investing has always been human plus machine, right? If you rewind back 40 years ago, they weren't using Microsoft Excel. Any investor now would say Excel is an absolutely critical part of my technology toolkit. So the things that we're testing in investing are all around enhanced productivity, automating kind of low value added activity to refocus our investors on higher value added enhanced alpha generation. In our client group, it's the same thing, right? We don't want to replace the interaction of a distribution person with a client, right? We don't think that that's sort of a wise decision, but if it can help with things that are more sort of administrative in the distribution process, we can refocus our people on higher value added activities.
Brilliant. Great. Questions? Lady there. Sorry. Just wait for the microphone to come over. Great.
Thank you. It's Natalie Conway from City Hive, and I'm a freelance journalist as well. I was really interested to hear that culture comes up in your investment analysis. Do you have that from your own clients, the people that are investing in your products, asking you about the culture at your firms too?
Yes. Look, it's really important, and I'll just take a moment to say, like, as a firm, I think we've been on. We're a publicly traded company, so you can see the background. We had a refreshed board, a new CEO a couple of years ago. We've been undergoing, I think, a very positive cultural evolution over the past couple of years, and that's a really important topic of conversation with our clients. They care a lot about, the involvement of the board, what the sentiment is like. They ask about employee surveys. So we do find that it's quite important, and I'm thankful and grateful that we have a good story to tell on that front.
Matt, you're keen to find out more about company culture, but how do you communicate your company's culture to investors?
Massively important. If every single stakeholder, here in the UK, the UK regulator talks about a purposeful culture as a key thing they look at to determine the health of an organisation from a regulatory perspective. So it's their starting point, and I think it should be our starting point as well as both managers, but also I would urge that for any investor into our business as well. If Lucas was talking about man and machine or person and machine, our industry is still very much people dominated. It's a people-centric industry, and therefore the talent that I'm managing for, the asset that I'm caring for, are people. So I'm unapologetic about spending a huge amount of my time, over 50% of my time, on culture, on people, on engaging with people, understanding that our assets, our people, are doing the right thing for clients. So I think it's the single most important thing, and everything flows from there.
Anything to add?
Yeah, not much. Obviously, I work for an organisation where culture has been discussed a lot this week in terms of changes in acquisitions. But I think what's really interesting is how you think about measuring culture. Like, how do you? Because you're never going to speak to a CEO who says, "Oh yeah, culture's awful." It's kind of reality. So again, I think this is where alternative data is really interesting. Turnover of people is obviously one measure. Glassdoor data is another way that you can really try and pick out on culture. because the question is not whether it's important, but again, how do you measure it? And then really importantly, this kind of point about what does it do in terms of valuations. There's no doubt if you've got two companies, both equal, one that you think has a better culture, that is the one that you will invest in. But if the valuations are slightly different, how much can you attribute to what difference that makes? And that's what I find particularly fascinating as an employee as well as an investor.
So it's an intangible asset, effectively. It's hard to,
valuing
very hard to
intangibles
measure.
is the most difficult thing of all, right? So it is, but it's a really, I find it absolutely fascinating in terms of, how do you actually measure it and measure the difference that it makes.
We've got time for one more question, I think. Okay, yep, please, after you, yep, thanks.
Thank you. Tom Howard, I'm a consultant. Just to connect back to what John Sawes was saying earlier, given the dominance of big tech in portfolios at the moment and the potential risk of conflict in the South China Sea or an embargo of Taiwan and the very important role of Taiwan in the supply chain of big tech, how would you characterize the extent and nature of the risk posed by such a conflict?
So just a small question to finish the panel with. Yes or no answer would do. Who wants to have a go at this thorny last question?
So that is the risk. I mean, it's probably, I've been visiting a lot of clients this week. Another question is, what changes? How does this reverse? What are the risks? And that certainly is, kind of one of the areas of risk that continues to be dominant in markets at the moment is just general geopolitical risk. And then again, the question we have to think from an investment perspective is how much of that is priced in, both in terms of the likelihood and what the impact will be. I think that it certainly would kind of have an impact on valuations, but it wouldn't cause a huge collapse, because it's not the only part of supply chains, depending on which of the companies that you're looking at. And unfortunately, we can't go into company specifics. So it is a risk, but it's not a monumental risk. And geopolitics are generally always a risk in markets. So it is a risk. It's a risk that we're always concerned about. Is it a risk that's changing our positioning at the moment? Not at the present point.
I've been instructed to keep to very strict timekeeping, but if you have very pithy remarks, Matt or Lucas, would you like to finish this off?
It's 11:30. I'd love to, but
We're at time, so If you imagine the Today programme pips, we can't talk through those. Any other thoughts? Okay, brilliant. Well, it just leaves me to thank my panellists so much for all your thoughts today, and please may we give them a round of applause. Thank you very much.